Hey, welcome to the Wealth and Wisdom podcast where intentional planning meets eternal perspective. It is Monday, August 18th, 2025. This is episode 3, and we're so glad you're here again. I'm Leonida, joined again by Brian Cochran. We are part of John Moore Associates, a financial planning firm serving successful and generous families all across the country. Each week, we'll continue to unpack current economic events, market trends, and real-life planning conversations, all through the lens of biblical wisdom and intentional stewardship to help you grow, give, and live with purpose. So today, we're going to start with some big macroeconomic data that came out last week. Everybody's always got their popcorn ready when they are waiting for the inflation numbers. That's been the big thing since COVID, and we've seen some trends change and adjust over the last couple of months. And last week, the CPI, the Consumer Price Index, the one that a lot of people are looking at, was about in line with expectations. It wasn't too bad. It wasn't too good. It was just kind of right what they were expecting. But the big noteworthy thing, Brian, was the producer price index. That's kind of what the input costs are on the producer side of things, not necessarily what consumers are paying at the store for things. It's what does it cost to make those things or produce those things. That was way above what they were expecting. And a lot of times we see PPI leads CPI. So if you want to know where inflation's going, what the cost at the store is going to be or the gas pump, you can look at PPI as a pretty strong indicator. And that's a little bit nerve-wracking for some people because the Fed has been talking about this idea of cutting rates, and the market is assuming with a 90% probability of certainty within the bond market that the Fed is going to cut rates this September. They're giving it about a 90% probability of a 25 or 1/4% rate cut this September. The problem with that is if inflation is on its way back up, that means the Fed's move is not to cut rates. But what we got a couple of weeks ago was that we were seeing some softening in the labor market, which the Fed has a dual mandate. It's full employment and stable prices. So they're trying to target a 2% inflation rate and an unemployment rate, generally 4% or lower. Well, right now we're seeing unemployment start to tick up and inflation likely going up too. Those are competing numbers there. Those are not pointing in the same direction for Fed policy. So we don't know what to expect, but I don't know that we have a 90% conviction that there's going to be rate cuts, even though the current administration is trying to put a little pressure on the Fed. We're not sure what our expectation is, at least not to the level of certainty that the bond market is. But even with that kind of macro backdrop, what did the market do last week, Brian?
It was surprisingly positive. As we looked through investment committee this morning, we had several positions in our portfolios that were up double digits. So the index was positive. We see certain names really racing higher. And even the small caps that have been a laggard, the smaller companies within the U.S. market, went up 3% last week. So trying to play a little catch up after falling behind over the rally over the last several months. A lot of positive sentiment, Cole, and I think that's a bit of a surprise. But we do see sometimes the market shifts significantly in its sentiment. And we often say it moves from fear to greed. And when things are really bad and the fear is the rampant emotion, then what we see is that it doesn't really matter if there's good news in the market, it won't go higher. And sometimes when the greed is in the air, you'll get bad news like that PPI report you mentioned, Cole. That PPI report was a big negative surprise, yet the market did not shift meaningfully lower. In a period of significant greed, you might not see much downward pressure on markets no matter what data we see. So I wanted to reference something that some of our listeners may not be familiar with, and that's the CNN Fear and Greed Index, if you will. And it's something we've referenced before, but honestly, it's been a few years. So I'm going to share that now for our viewers here. So what CNN does is they aggregate various metrics, and then they score the current status of greed or fear on a 0 to 100 scale. So the higher the number, the more greedy the market appears to be. And right now, we're pretty much right in the middle of greed, but we haven't moved to extreme greed, as you can see here. So sometimes we see this as a contrarian indicator. If the market's getting a little ahead of itself, a little too greedy, maybe it's a good time to be cautious. As Warren Buffett once said, it's good to be greedy when others are fearful and fearful when others are greedy. So to give you some context of how much this can swing, let's talk about this year. CNN allows us this nice little timeline here. If you go back to April, during that tariff tantrum we referred to, we got down to a 3. So on a scale of 0 to 100, the market was at a 3 in its enthusiasm and its level of greed. So it was a level of extreme fear. In hindsight, great buying opportunity, right? If you want to be contrarian, you would see that fear and get a little bit greedy. Here we are now in the kind of high 60s to 70s in the last few months. So we're definitely out of that fear mode and a little bit of greed. And this doesn't mean you should go all in or all out of the stock market, but Cole, when you think about that cycle of fear and greed, what kind of planning considerations or portfolio considerations come to mind to you, maybe at where we are today, a little bit more on the greed side?
Yeah, it's really interesting to see how this matches up when we are above our measure of trend. We're going back, several decades, and we've got ourselves almost 10% above that long-term trend right now. Generally, when we're well above trend, we see that greed index start to climb up. It's kind of that fear of missing out. People are getting greedy because things keep going up and up and up. And when we have instances like that, it doesn't necessarily mean that we're picking the top or we're sure things are going to go down. Things can go up and be expensive and continue to ride that wave for a long time, but it can be a really good tool from a timing perspective for a couple of portfolio moves that would support your overall financial plan. And the first one would be to sell high. It's kind of one of the basic tenets of good portfolio management is buy low and sell high. Well, you can do both of those things at a period of time where something gets a little bit ahead of itself or it's doing really well. Say, large cap US stocks. Those are the ones that are above trend right now, doing really well. A lot of that greed is getting poured into some of those companies. Could they continue to go up? Absolutely. But now could be a good time to sell some of those. If you're a retiree, now could be a good time to sell those and raise some cash for upcoming income needs or distribution needs. If you're thinking about some big expense, a home remodel, a car purchase, now could be a good time to sell some of those winners, raise some of that cash, and use some of the money that you've earned through investing. It also could be a really good time to simply rebalance your portfolio. While some positions like big US stocks or some international stocks have done really well, some of the small companies haven't done quite so well, or maybe some of the alternatives you might invest in maybe haven't done quite as well. Well, maybe sell some of the winners and buy some of the losers. That's called a rebalance. There's no reason you have to wait until the end of the year or the end of the quarter. This could be a good time for that if you're trying to be a little bit tactical about it. Another really good thing to do when we're above trend and we're seeing that greed index start to work its way up into those higher measures, giving some of your appreciated stock. As Brian said last week, we had several names that were up double digits last week that put them up a lot since we bought them. If they're long-term positions, it could be a really good thing to give away to a donor-advised fund, which we did kind of a dive on last week as a great tool for generosity to receive long-term, held more than 1 year, appreciated stocks, bonds, mutual funds, real estate, business interests. But right now, it's really easy to give some stocks that have gone up a whole bunch. So those are two really good kind of tactical timing pieces that fit into your overall strategic financial plan. Anything you'd add to that, Brian?
Now, that was really well done, Cole. I would add there's a whole other set of decisions you might make in those times of fear. So rather than be paralyzed or make bad decisions, there's some good things you can do when the market turns over to the fear side. But you mentioned it a couple times, Cole. I'm going to reinforce it. Just because the market's at all-time highs, just because it seems expensive, or just because it seems greedy right now, does not mean the market cannot go higher. So this is not a time to say, this is too good, or I'm at all-time highs. All-time highs tend to get more all-time highs, is what we know from history. So the key is you don't want to make big moves. You don't want to get caught up in the emotion during one side or the other. What we encourage you to do is have a strong process. And if you don't have that, that's part of what we bring to the table as advisors, is we have a process for making these decisions. We have limits. We have thresholds as to how much we're going to allow a position or a portfolio to move in these times of euphoria and greed. So we'll see how this plays out for the next few months as we move to the latter part of the year here and start thinking about year-end planning just around the corner. But right now, I think the moves you talked about, slight rebalancing, gifting stocks, great options in a time where the market's on a strong run.
Yeah, and you mentioned the process, and to stick to a process when everything tells you you shouldn't, that requires discipline. And Hebrews chapter 12 tells us that for the moment, all discipline seems painful. Selling that winner that won't stop going up can seem painful, or buying that loser that only looks like it could go down further, that seems painful in the moment. Rather than pleasant, but later it yields the peaceful fruit of righteousness to those who have been trained by it. I feel like that is one of the biggest values of our investment committee, is that we've been trained by that discipline over the years, over the decades that our committee's been doing this. So I've only been part of the committee for 4 years now. Brian, you're a little over a decade, but there's decades of cumulative experience of being trained in that discipline, even though it might seem painful in the moment. So that process is highly valuable and is proven to be to bear fruit over time.
Yeah, and the last thing I've mentioned on the fear, greed, and these decisions is if you're getting caught up in the fear, or if you're getting caught up in the greed, that just means you have a functioning human brain. We're all prone to those emotional swings, which is why the process is so important to us as advisors, is we need something because we can get caught up in the fear and the greed. So it's so important to have the process to override what could be a really bad decision of the highs or the lows, so that you can not blow up your portfolio and maximize your odds of success. So very, very important. It's one of our great honors is to walk alongside clients and help them avoid those big mistakes that come with the emotional swings. And you overlay politics and potential personal family issues that could be going on that influence our emotions and our decisions. There's a lot there that seems like it's just designed to interrupt a successful plan. So again, it's our privilege to have those conversations with the families we serve to help them avoid the mistakes and lean towards the right decisions when the emotions are high. So thank you all who are watching, who are clients, that allow us to be part of that, because it's a very personal, and very private thing a lot of times, what's going on in your lives, and it's our privilege, our true privilege to help you out in those times.
Yeah, and every money decision is truly a heart decision. And a lot of times emotions or politics, those are issues of the heart that then impact the decisions we make with our money. And it's part of our job to just be objective and principled and stick to biblical wisdom when it comes to the advice we give, the portfolio moves we make, anything along those lines. So, Brian, anything else you'd add before we sign off here?
Well, you mentioned at committee today, there's a big meeting coming up this week. Do you want to mention that as one of the points we might reflect on when we get together next week?
Yeah, there is a big meeting this week in Jackson Hole, Wyoming. And the Federal Open Market Committee with Jerome Powell there at the helm is going to be meeting this week, talking about policy moving forward. He actually speaks on Friday. We have a couple of Fed presidents that are going to be speaking this week as well. There's also an empty chair on the board as well that the current administration can appoint someone to. So there's a lot to keep an eye on here. There's a lot of jockeying for position on who's going to be in that. It's not supposed to be a political piece, but unfortunately, politics finds its way into almost everything. So we're going to be paying close attention to what comes out of that meeting, what Jerome Powell says on Friday, because that's going to give us a little bit of insight as to what to expect with interest rates, which has ripple effects through the rest of the economy and the market. So very important towards the back half of this week.
Outstanding. Yeah. So thanks for that. And as always, we'll stay on top of the data, stay on top of the markets, and look forward to these weekly updates. We'll see you guys, I guess, next Monday, right?
Yeah, so thank you all for joining us on the Wealth and Wisdom podcast, where intentional planning meets eternal perspective. If you did find today's conversation helpful, please like the video, subscribe, get the notifications, and share it with someone else who might benefit from this. For more resources and timely insights, visit our insights page on johnmoore.com, where we regularly post blog posts and videos, as well as all of these podcasts as well. So until next week, have a wonderful week.